Let's wrap up the markets in West Africa. Starting with the BRVM, up significantly yesterday, about 3.3% to 219 points. That's for the BRVM 10 index. And the composite likewise was up 2.6% to 196 points. Stock value traded in the market was down to 269 million CFA francs, and the currency currently trading at 505 CFA francs to the US dollar. In Ghana, we saw the market move up only slightly to 1,777 points for the JSC composite index, while the JSC financial stock index was also up slightly to 1,586 points. The market is up about 48% for the year, and the CD currently trading at 1.96 CD to US dollar unchanged compared to the previous day's position. And for the Nigerian market, we saw the market up about 0.25% to 33,090 points, driven higher by the banking sector. And we'll cross now to Stanbic IBTC, where Muyiwa Oni, a banking analyst, is standing by to give us some perspective on the numbers we've seen recently from the banks. Muyiwa, thank you for joining us, and if you can wrap up your thoughts on the Q1 numbers we've seen so far, particularly for the Tier 1 banks, because they have led in terms of getting out these numbers. We're still expecting First Bank and UBA to release, though, but your thoughts about what we've seen so far, particularly from Zenith and GT Bank?
Yes, well, like you said, the Tier 1 banks have pushed out results, and the numbers look quite impressive. And I would say, looking at some lines, they seem to be beating analyst expectations right now, especially on the loan growth line. Zenith Bank's numbers showed loan growth, Q1 loan growth of 11%, which is quite impressive. And GT as well published loan growth of 5% in Q1. Both banks were guiding 20% loan growth by the end of the year, and we felt that was optimistic given the tough environment and how banks have been quite conservative to growing loans, and Zenith especially, given his historic conservative stance, and so far they seem to be leading. And if you compare them with the Tier 2 banks that have published results on loan growth line, the Diamond Bank released Q1 numbers showing just 1% growth in net loans, which looks quite disappointing, especially if you consider the 50% growth in loans which we saw in 2012. So I'll say on the loan growth line, the Tier 1 bank seems to be leading. Access Bank, which based on size now can be classified as a Tier 1 bank, but if you look at a few more metrics, it's still emerging. Also is lagging Zenith and GT Bank on loan growth line. Its loan growth is up 3% year till date as at Q1, but still lagging the top banks. And also, if you look at the EPS line, all three banks, apart from Access, seem to be performing positively right now. Access Bank showed weak and disappointing EPS growth. It was down 16% in Q1, which was disappointing, and not the market wasn't expecting such a weak performance on that line, but with the others it's been quite positive.
Is that impacting your rating of Access Bank? Like you said, a bit disappointing Q1 numbers there.
Well, the outlook is obviously weaker now than we had historically, and so obviously we're more not as constructive as we used to be. And I would say, to be fair, it's a point that we've highlighted historically as well in previous reports, especially considering the combined bank. And our view was that 2012, 2013 will still be transition phase, and it will still take some time before the bank will be able to take advantage of the larger platforms. So in terms of ability to drive down cost of funding, our view was that it was still going to take some time, and the bank seems to be challenged on that front right now. Cost of funds is currently around 5%, which is high for a bank of that size. If you compare to Zenith or GT that have cost of funds lower than 4%, and so obviously we do think that it will still take some time before Access is able to take advantage of the larger platform.
Right. You made a point about the loan growth being a very strong positive, but I know last year there was a strong view that cost containment is going to be key for the banks that will succeed in this environment, more so because everyone is expecting very moderate loan growth. Your thoughts about what we've seen, and you can even go back to the full year numbers in 2012 about how banks are doing in that respect.
I would say on the line on cost containment, I think our view was really more on ability to manage cost of funds, not so much of the operating cost, which we think is obviously important, but there are some costs that is more tied to inflation, and it will be more difficult to banks to manage, especially if you also consider that banks have been on cost-cutting phase for some time now. Since the CBN intervention, there's been far more focus on cutting costs, on centralizing processes, trying to make processes more efficient. And so our view was that on such lines, it would be far more difficult to cut costs. And so even though GT Bank, for example, had cost-to-income ratio around 35% as at Q3, our view was that it wasn't sustainable. And right now, 42% looks like the most sustainable level. But our point was really more around cost of funds. We thought, or our view was that banks that were able to keep cost of funds low would be able to still keep net interest margins and revenues strong by the end of the year. And so, especially if you consider that yields on assets was going, the outlook on yields on assets was more on the decline, and so our view had, our view has been to favor the tier 1 banks, which had a larger balance sheet and had a better cost funding structure, and also Diamond Bank, interestingly, even though in terms of size is still small, but has also been able to keep cost of funds low. And so our view was that banks with lower cost of funding will be able to keep their net interest margins stable and will see less volatility. And so if you look at Access Bank, for example, with higher cost of funding, the net interest margin is also quite volatile. And by the time we look, we see banks like Sky or Fidelity Bank as well release Q1 numbers, we won't be surprised if net interest margins are also quite volatile. Right. So our view is that banks that are able to keep cost of funding low should be able to still keep revenues strong. Or,
right.